Live? Oh yeah. Well, welcome to 9 valuation mistakes and how to avoid them. Kay, do you have a book? 9 valuation mistakes? I think I've got one here. Let me just show you. I'm going to talk about the contents of this book. And basically, I'm going to tell you a little bit about where this book came from first. And this book really came from my work after more than 25 years as teaching finance and teaching valuation, and then my years as an analyst all my career, and then over the last couple of years through the Valuation Master Class, where I've worked with a lot of students to see. So today we're going to talk about them. Now, a little bit of background on me. I've had about a 25 plus year career in finance, starting from the absolute bottom. I worked in many different positions at brokers, investment banks, including head of research and portfolio manager. Another proud accomplishment was when I was voted #1 analyst in Thailand. I also volunteered with CFA Society Thailand and eventually served a 2-term presidency, which was really an honor of a lifetime. Eventually I started my own business called ASTOT's Investment Research, and I've learned a ton of valuable lessons that became the foundation of what I'd like to share with you today. Now also, I will have a special offer for the ambitious few who are watching this, who really want to go deeper into valuation. It's something I've been working on for years, well, decades, and it's one that can help you become a better financial analyst. And most important, ask questions. It's fun. Ask questions, submit any questions you may have about valuation. Are you struggling with a question in valuation right now? We may be able to answer. All you gotta do on Facebook Live or on YouTube Live is just submit them in the comments. All right, let's get started. 9 valuation mistakes and how to avoid them. I'm just gonna review the 9 mistakes as a start. First of all, overly optimistic revenue forecasts. I see that all the time. Number 2, underestimating expenses causing unrealistic profit. Number 3, growing fixed assets slower than revenue. Number 4, confusing growth capex with maintenance capex. Number 5, forecasting drastic changes in the cash conversion cycle. Number 6, underestimating working capital investment. Number 7, valuing a stock using the calculated beta. Number 8, choosing an unreasonable cost of equity. And number 9, not properly fading return on invested capital. Now, before we continue, I always want to reiterate to everybody watching that really valuation, forecasting and valuation is about developing a story about a company. Great investors have a story about why they're investing in that particular stock. So when your forecast and your valuation deviate from the past or from consensus, make sure you're not just making one of these 9 common mistakes. If you are not, and you've checked that, then you've got a story to tell, and your objective is to tell that story. Why? Because your story is your value. Now, I like this picture. All 9 valuation mistakes come from my experience as head of research and from students in the Valuation Master Class. Okay, you like that picture?
Yes.
That's a good one. So let's talk about the first one, overly optimistic revenue forecasts. So the point is that revenue growth is the most important item because it's at the top of the P&L. And research about revenue happens outside the office. You've got to answer critical questions like how many people are on the sales team, who is running the sales team, what's the growth plan, what are the constraints to sales growth, etc. Now, let's look at this chart for a moment. And what you can see is all the dots on the chart is the growth rates of sales of all companies in the world. And this growth rate right there, you can see, is a little bit over 10%. So it's about 13% in 2000, and the slowest was minus 10%, which you can see right here. And what we can see from this is that the average growth rate has been about 6%. That's all the companies that are listed in the stock markets over the years. That's a much more difficult number to calculate than you may think. I can tell you why if you had a question about it or if you wanted to know more. Now, can statistical tools help us to forecast revenue? We can do a regression, but what we find is that what the regression predicts versus what actually happens is almost never going. The relation would be that revenue growth would fall substantially, but in fact, it rose. And here you've got another trend and another, and you could also try to do a long-term trend. So a long-term trend there. Oops, sorry about that. Something happened to my screen. Hold on, let's see. I'll be right there. It just switched. Hold on. Let's just see. Hold on. Technical difficulties. One moment. Okay. That should bring us back. All right. Oh, a big hand for K. Well done. All right. So let's go back to what we were talking about. And I was talking about these lines, and I was telling you about even a long-term trend line appears like it could work, but in the end, it doesn't work. So what I would provide to you, the idea that no statistical tool works. I've never seen an analyst that's using a statistical tool. Of course, sometimes they'll use a statistical tool, but they'll adjust it. So if you're adjusting it, then the statistical tool is not really working. And the reason why is because finance is part art and part science. And once you realize that, you stop being so precise and think more about direction. So this is how my Valuation Master Class students avoid mistake number one. Understanding the business and its constraints to growth. It's my favorite question to ask, what are the constraints to growth? And I'd ask you, what are your constraints to personal growth? There's an idea. So let's review what you've learned. First, revenue forecast is most important forecast. Build it away from your computer. Ask, what are your constraints to growth? You want to understand, of course, marketing, branding, and other things like that. And what I really want you to understand is y'all. And y'all means you are always wrong. In fact, my academic research shows that analysts are wrong all the time, optimistically wrong in particular. All right, let's move on to valuation mistake number 2, underestimating expenses causing unrealistic profit. Analysts tend to be overly optimistic and forecast a high or rising gross margin. Be careful when forecasting because a small percentage change, like even a 1% increase in gross margin, can have a massive impact on the net profit. And plus, it's hard for management team to increase the gross profit margin. Trust me, your bosses, myself, others, everybody's struggling to increase that gross profit margin. Now, I've looked at the gross profit margin across companies around the world, and that's the red line here. I've made an average line in the middle, which you can see this flat average, and two standard deviations above and below. And we can see that the gross profit margin ranges between 27 and 29%. It's not a particularly volatile measure because it's up towards the top of the P&L. Now, this is how my Valuation Masterclass students avoid mistake number 2. They're cautious with large changes in gross profit margin. So what have you learned? On average, the gross profit margin is 28%. Focus your forecasting mainly on revenue and cost of goods sold. Because if gross profit margin is 28%, that means cost of goods sold is 72%. That's a massive contribution. So that's the place you want to focus. Also, large changes in gross margin are unlikely. If you're forecasting the large changes, then tell the story. Because why? Your story is your value. And of course, as I constantly say, curb your enthusiasm. Now, number 3 is growing fixed assets slower than revenue. Analysts often underestimate fixed asset growth. It takes investment to grow revenue. It's unrealistic to forecast a company to grow revenue without growing its assets. So a rule of thumb is fixed asset growth should roughly match revenue growth. Now, one of the ways you can check this in your model, just open up any model that you're working on and look at the cash in 5 years from now. If the cash as percent of assets is massive compared to where it is today, you're probably making this mistake. Now, you can use the asset turnover ratio to prevent this mistake. The asset turnover ratio is represented by the falling line that you see in this chart. And what's interesting is that we're supposed to be in a time where we've had rising stock markets and good times, but yet the asset turnover has been going down and down, implying that companies are investing in projects that are returning less revenue per the assets that are being invested. All right, so this is how my Valuation Masterclass students avoid mistake number 3. They use the asset turnover ratio to check that their growth in assets is matching their growth in revenue. So what have you learned? Over the long run, companies should grow fixed assets about as fast as revenue. Also, if you forecast differently, then this is an excellent point of discussion, because remember, your story is your value. And prevent this mistake by using the asset turnover ratio. Let's talk about number 4, and that is confusing growth capex with maintenance. Analysts should consider the 2 types of capex, maintenance and growth. Maintenance capex is for existing assets. We've got to maintain them to keep them producing the same amount of revenue and profit. Over time, these assets depreciate, but they must be maintained. For additional growth, if you're forecasting the company's going to grow its revenue a lot, then you want to forecast more growth capex, and that would be the additional capex that you expect. Now, I looked at all capex at companies, in this case in Asia, and I just looked at the 261 largest companies in Asia, and I added up all their capex, and then I tried to split the maintenance from the growth capex, and here's what I found. The lower bar is the maintenance capex, and it's a very steady amount, slowly rising over time. So when you're looking at forecasting capex in your P&L or in your balance sheet, then you want to probably have capex at least matching the maintenance capex in the P&L. The rest of it is growth capex, and it's a little bit more volatile. So this is how my Valuation Masterclass students avoid mistake number 4. Forecasting capex as at least 100% of annual depreciation, and probably much more if it's a growth company. Now consider both. What have you learned? Consider both growth and maintenance capex. Maintenance capex should be roughly the same as depreciation. The starting point for overall capex forecasting is 100% of the annual depreciation charge, and additional growth capex depends on how fast you expect the firm to grow. All right, number 5, forecasting drastic changes in the cash conversion cycle. I once went to see a company that was a manufacturing company that had a cash conversion cycle of about 40 days. That was already slightly better than the industry average that they were operating in. But over a 5-year period, that company brought their cash conversion cycle down to -7 days. I've never seen a manufacturing firm with that low of a cash conversion cycle, and that frees up a lot of cash. I went out to the factory to visit it to understand what they were doing, and what I learned is they focused a lot of their energy on reducing inventory, raw material inventory, work in process inventory, and finished goods inventory. So let's talk about this cash conversion cycle. When it comes to the cash conversion cycle, focus on inventory, because handling of inventory is really a core management function, and it's the one thing the management team can really control. Analysts often forecast unrealistic changes in a company's inventory conversion period, not considering how hard it is for management to improve their inventory management. And I know the case because of my own business, Coffee Works, that the management team struggles to reduce the amount of inventory on the floor. So I've calculated the cash conversion cycle. In fact, I've calculated all the different ratios related to the cash conversion cycle. And the cash conversion cycle is this middle dotted line, and we can see it doesn't change that much. So if you're forecasting some dramatic changes in the cash conversion cycle, you probably are making one of the 9 common mistakes. So this is how my Valuation Masterclass students avoid mistake number 5. And this was students, by the way, that picture were students in Shanghai that I taught together with my professor, Dr. Lu Wei, in China. But I teach them to avoid this mistake by focusing on inventory and avoiding large changes in working capital. All right, so what have you learned? Well, I can tell you that the average inventory days is about 57, receivables about 64, payable about 40, and cash conversion cycle about 82. You want to avoid huge changes in working capital items, except in rare cases of product mix or management policy. Focus much of your attention on inventory because that's what management can control. If you forecast big changes in your cash conversion cycle, well, explain your reasons. All right, now, are you asking questions? I'd love to get some challenging questions in this event, so feel free to submit them in the comments. All right, let's move on to mistake number 6, underestimating working capital investment. Net working capital is difficult to forecast because it results from 5 separate forecasts: accounts receivable, inventory, other current assets, accounts payable, and other current liabilities. Now, to avoid the mistake of underestimating working capital investment, think of the change in net working capital as an investment, just like the investment in fixed assets. So, from my experience, startup companies almost always have to have a lot of money sunk into accounts receivable, sunk into inventory, and they're not going to get a lot of credit terms to support that. So usually the change in net working capital is a cash outflow and therefore reduces the free cash flow. But this spending should support growth. The reason why this net working capital item is such a critical one is because it's a critical calculation in forecasting free cash flows, and therefore a free cash flow valuation is dependent on you getting the right number for the changes in net working capital. Now here I looked at all of the changes in net fixed assets, or we can call it capex, and the changes in net working capital. The net working capital is like the cap on these, the little item, and the capex is the bigger item. But the net working capital can swing and go positive sometimes, as we see in this chart on a few occasions. So this is how my Valuation Master Class students avoid mistake number 6. Looking at past trends as a guide for net working capital. So what have you learned? Unlike in accounting, in valuation we exclude cash and short-term borrowing from net working capital. Changes in net working capital are volatile because that chain results from 5 separate forecasts. And net working capital is a small but volatile investment item. Large deviations from past trends usually are a mistake. But if you didn't make a mistake, then you've got a story to tell. All right, let's move on to number 7. Valuing a stock using the calculated beta. The problem that I see often is using a too high or too low beta. So just using whatever historical beta that an analyst or someone finds on Bloomberg or from a data provider. Or calculating your own beta can be a mistake. The real mistake is failing to realize that the valuation is made to infinity. Hence, your beta is a forecasted beta, and that forecast is to infinity. So what beta should you use? Good question. Well, I've done a study where I've looked at high betas and low betas, and I've tried to understand, do high betas stay where they are? Do low betas stay where they are? Or do they rise or fall? And here's what I found. High beta stocks, or the group of high beta stocks, drop very quickly within a year. And low beta stocks rise very quickly within about a year. And then after that, they maintain a level above average for the high ones and below average for the low. Which basically means that if you look at the long term, we can see 1.221 and 0.68. So what do? I teach my students to try to use a range of 1.25, 1, or 0.75. If it's a high risk stock, use 1.25. If it's a low risk stock, use 0.75. When you're going to say, but Andrew, the beta I just calculated is 2. How can I use 1.25? First you can see that the beta will fall very quickly on average. The second thing is, remember, you're using the beta to infinity. All right, this is how my Valuation Masterclass students avoid mistake number 7, by selecting a beta of 0.75, 1, or 1.25. Outside of that, it's okay to use a beta outside of that, but the problem is you want to be able to explain why you're doing that. All right, so what have we learned? Past beta trend tends to regress towards 1, but the betas that we use are to infinity. And therefore, to avoid the mistake of using a too high or too low beta, use betas in buckets. A high risk bucket, 1.25, the low risk bucket is 0.75. Now if you use a beta outside of this range, you have a higher obligation to justify, plus you probably got a story to tell. So let's talk about number 8, choosing an unreasonable cost of equity. A common mistake made by analysts is discounting future cash flows at an unreasonable cost of equity. This can massively impact the final valuation, and even if your forecasts are perfect, would cause a wrong estimate of value. Now, the cost of equity, if your assumption of the cost of equity is too high, you'll underestimate the value of the company. And if it's too low, the estimated value will be too high. This is a good chart to look at because what we can see is that I've tried to calculate the value here, and I've changed the cost of equity and kept everything else the same. So a company with most recent dividend of 10 and a growth rate of 4 and a cost of equity of 6 will have a value at 520. But if we change that cost of equity just from 6 to 8, it cuts in half. So there's an exponential movement we can see at that point. And that's the reason why I call this the danger zone. You want to be very, very careful of really low cost of equities or discount rates. This is how my Valuation Master Class students avoid mistake number 8. They use a cost of equity between 8 and 13, and when they go outside of that range, they have a story to tell. So, what have you learned? Don't get lost in the components of cost of equity like beta, risk-free rate. Instead, focus on the final result. And too high or too low cost of equity can significantly change the estimate of the firm's fair value. And based upon the study that I've done, I would consider a range of 8 to 13% for large liquid companies. Obviously, there's some companies that are outside of that range, but that's a good place to start. All right, let's go on to the number 9 valuation mistake, and that is not properly fading return on invested capital. So analysts often forecast high return on invested capital companies will maintain that high level, and low ROIC companies will maintain that level. But it's impossible for a firm to maintain a high level of profitability forever, and neither losses. Eventually, it's going to be taken over, it's going to shut down, it's going to have a change in management, change in ownership. Fading down the ROIC reflects the idea that firms cannot sustain excessive returns to infinity. So I did the same type of test looking at the high ROIC and the low ROIC companies, and I found, similar to beta, that they very quickly regress towards the mean. And the result of that is that they don't also, just like beta, they don't get at the mean. Therefore, there are companies that have high ROIC that we're going to say will always have a high ROIC, and there's companies that have a low ROIC which will say will always have a low ROIC. And therefore, when I fade down the ROIC, I don't fade it to the cost of capital. I fade it to a premium or a discount, depending on whether it's a star or a dog. So this is how my Valuation Masterclass students avoid mistake number 9. They fade the ROIC to a premium or a discount to the weighted average cost of capital. So fading ROIC to WACC reflects the ideas that firms cannot sustain excessive returns to infinity. Very profitable firms decrease in profitability, and low profitability firms will increase in profitability. So fade highly profitable firms to about a 20% premium to WACC, and unprofitable firms to about a 20% discount to WACC, and no fading is required for average ROIC companies. So there you have it, the 9 valuation mistakes that we just went through. Now, I'm going to tell you about the Valuation Master Class. Well, my career was a mountain to climb. I wanted to be number 1. But I needed to learn practical experience for equity valuation, and it took me a long time in my career. That's why I started the Valuation Master Class, to help people get practical experience quickly. Number 2 is I needed to gain confidence in order to advance my career. It took me a long time to gain that. But if you can do many valuations as we do in the Valuation Masterclass, you'll start to gain confidence, and that confidence will matter in your future career. Number 3, increase efficiency. I see a lot of people waste a lot of time, but with the Valuation Master Class and the value model that I use, I'm going to teach you every shortcut that I can possibly come up with. If you can come up with a better shortcut than I've got, I will be amazed and will incorporate it. And finally, you want to become an expert by having a large impact, reaching a large number of people. So the 4 things, these are the key things that if you can master them, will accelerate your career more than anything else. So what are some of the other resources to build your career? Well, I'm a huge advocate of CFA. You can't see my books over here, but I got tons of books. I love reading, I love learning. CFA is an amazing curriculum. And that's a good way to get a very broad understanding of the finance industry. Here I show you the different topic areas that have been announced by CFA Institute. And one of those areas, of course, is equity valuation. The Valuation Master Class goes deep into equity valuation. It just doesn't make sense for the CFA exam to go that deep, because that's not the objective. But for those people that want to go deep, that's what we do. So it's a step-by-step system. That means the graduates of the Valuation Master Class are in the top 1% among their peers in terms of practical experience. There's no other program in the world that offers that. Also, the second one is about building confidence. This gives you confidence you need to crush your interviews, to get a high-paying job, to make conviction calls, to confidently sell your ideas, and ultimately, your job is to outperform your peers, bring more value to yourself, to your company, than your peers bring. And number 3 is about building efficiency. The next step is really about getting efficient. How do you initiate coverage on new companies quickly? How could you cover twice as many companies as your peers? That's a challenge. Standardize your process, as I teach in the Valuation Masterclass, to reduce errors and save your company time and money. And this increases the value that you bring to your company. And the last one is step 4, which is increasing impact. So this is where you become a true expert. You shout your opinion about the markets for the world to hear and be right. That's the best feeling. There's no greater feeling than that. Of course, you're going to be wrong sometime, but you're not going to be wrong for stupid reasons that you didn't think things through. You've got good arguments to your point, and of course, you're going to be rewarded for that over time. So there's hundreds of students from all around the world who are in the program right now. There's a map, and I've got a group of students that are coming in from some other companies. We've got some new students coming from Africa. We've got some new students coming from Pakistan, and the student list continues to grow. In fact, one of my friends who's the CEO called me and said, make sure you send me the best Valuation Masterclass students that you have, because he knows that I'm no bullshit, right? My students are qualified and capable. And that's why I make the promise in the classes that I personally guarantee a job related to equity valuation for all Module 5 graduates. I don't have any fear to make that claim, because I know that my Module 5 graduates are the best of the best, and any company that interviews them will know that. And I'm willing to put my reputation on the line to support them. Now, I've told you about the Valuation Masterclass for those who want to push themselves to a higher level in the field of finance. We are the Valuation Masterclass live, and that's on February 16th and 17th in Bangkok. So now I'll show you a very special offer only for those watching this, and it expires on January 31st at midnight. So get ready. Here is the special offer. The Valuation Masterclass at $500, about $15,900. And that's about a $630 value that you're going to get for about $500. Now, also, if you enroll before midnight, you're going to get 50% off Module 2, and you'll get that for free. But it doesn't make sense from a financial perspective for me to keep this offer open for a longer time than midnight tomorrow. But there's more. If you sign up by midnight today, not only do you get a 50% discount on Module 2, but you'll also be eligible for a 40-minute one-on-one career consultation. And if you're in Bangkok, stop by and join me for a coffee. We'll discuss your professional goals, some strategies to achieve them, and if I can, I'll put you in touch with my network. So there we've got the Valuation Masterclass Live, 50% off Module 2, a one-on-one career talk, which is worth about $300 for free. And now the last thing is a free copy of the book. It's a 95 pages of goodness. And it's everything that I have in my head in that book. So that brings 9 valuation mistakes book in there, and that basically means you're going to get a ton of stuff if you act now. The next step is to sign up. And if you want to take it further, this can help you build a career in finance. So this, the price is $500. The value, which is what you learn in the Valuation Master Class, the difference between price and value, is more than $1,000. But the offer is only good until midnight Bangkok time, January 31st. And if you're not in Bangkok and you do all 5 modules online, that's $200 per module. Currently, a 50% discount on module 1, you'll save $100. So sign up at valuationmasterclass.com and get started right now. So let's see if there's any questions coming in on our Facebook Live or YouTube Live. All right. Looks like any questions coming in, Guang?
No.
Okay.
But like for me, I wonder that why it's got to be like 20% premium or discount.
So the question is, why is it a 20% premium or discount? The reality is I made that up. Now you could look at the chart and see where it fades down and see that it's about 20% premium or discount in the chart. But ultimately, it's a little bit of a made up number. I don't want to go higher than 20% because I'm afraid that people will have too high of a fade. And if the fade is too high, it means the returns of the company is way above the cost of capital. That's probably unrealistic. All right. So, hold on. Any last questions? Hold on. We're trying to pull those questions off the...
What is the total cost to get to module 5?
The total cost to module 5. Well, right now, we've got each module at $200. So that's about $1,000. So obviously, if you sign up now, you'll get a discount on that, and that discount will also apply as we've shown on modules 2 and 3. Other questions? And we'll provide more information in the comments. Any other questions? All right. Well, if you have questions, just leave them in the comments, and I'll be happy to try to answer them. And I hope to see you in the Valuation Masterclass or the Valuation Masterclass live in a few weeks in Bangkok. Have a great day.